Hey everybody, welcome to Trading Cap's exclusive analysis of the three sectors we're going to be discussing in this video is healthcare XLV, consumer discretionary XLY, and consumer staples XLP. Starting with XLV in the S&P 500, notice how XLV had this little micro head and shoulders pattern, left shoulder, head, right shoulder. It triggered a few trading sessions ago, and what looked to be setting up as bearish consolidation had an epic gap up and reversal. Now this pattern has now negated since we have a bullish close over the neckline of this failed head and shoulders. With failed head and shoulders patterns usually means more upside. So we have to respect where the chart is at right now. One thing I want to point to your attention is that XLV, this is the key trend line connecting this pivot to this pivot to this pivot, where you clearly see you've had an attempt at a breakout here, which failed, needed more consolidation, another attempt over here, failed, another attempt over here. That was our closest attempt, which failed. And then this last failure looked like we were actually going to be losing this bullish pattern, closing under some key moving average and putting in sideways chop to go lower. But it has been negated on a decent earnings report from one of the heavier names in this particular ETF, which is UNH. So UNH had a strong gap up on earnings. This chart was looking exceptionally bearish with a breakdown. Doesn't mean it can't go lower, but being the fact that the earnings came in better than expected, beat Wall Street, you had an epic reversal on Friday, up 7.24%. And with UNH bolstering a weighting of 9% in this ETF, it's a little bit skewed. So we have to keep in mind that just a handful of stocks in the XLV ETF like UNH, like Eli Lilly, like Pfizer carry an exceptional amount of weighting and can definitely skew the price action in the short term. So let's discuss what's happening here. I think being the fact that we've had multiple attempts at cracking this trend line, we've weakened this trend line. So I do think that there's a very strong likelihood we could actually break out of this trend line. It's a beautiful wedge pattern. If you get a breakout of this trend line, it could signify some meaningful upside in healthcare. And even if you throw in all of the key moving average, I mean, we have just been trading in this cluster. Look how messy this chart looks because of this cluster of moving averages. We have basically 7 moving averages in this area that have just been coiling. So one way or another, we're going to get a very, very big directional move. It's very, whenever you see this cluster of moving averages coiling in such a tight range, it means a big move is likely going to occur in the immediate term. And I do think that move could be potentially to the upside if we get some follow through and truly break out on the chart. Specifically, if we break out of this pattern on the weekly chart, it could bolster a decent upside move in the near term. Now, a couple of different individual stocks that I'm looking at in this particular sector, in terms of healthcare's 1 year to date performance, it's still down 3% on the year, but there's some interesting names that we have to pay attention to. Illumina has been one that has certainly been, sorry, let me just go back to the front end of my page. ALGN has been a market leader in this particular ETF. So if you pull up the ALGN Align Group, kind of the medtech, it has had a phenomenal move. I sold my ALGN position, so I'm all out. Let me just quickly erase that trend. But ALGN is now hitting some minor resistance. It's looking like a little bit of distribution is coming in. But again, a simple pullback back to the short-term moving averages could technically be bought since it is still technically in an uptrend. But you're really starting to see the trend in medtech, ISRG, up quite substantially. Stryker, West Pharmaceutical Services. So there's a trend in medtech that is certainly bolstering a lot of strength. You look at another one which carries a bolstering weight, Eli Lilly. Eli Lilly's potentially running out of steam. It's still holding the daily chart uptrend of the 50, the 100, and the 200. So nothing is broken as of yet. But just watch out for some of these market leaders because you may see a rotation out of some of these ones that have flown into the stratosphere, and maybe a rotation into some of the ones that have beaten down more. So there's a couple pair trade opportunities. I like the pair trade of long Pfizer, short Moderna kind of thing. Moderna is an interesting chart on the weekly chart. Take a look at this weekly trend line that Moderna is testing, and it just seems that even though Moderna is so way off of the highs, and it has been just getting bludgeoned every time it makes a move to the upside. You see these top wicks forming. That's showing that sellers are just relentless in this name. This is a huge level. If Moderna breaks this key trend line going all the way back to 2020 when the vaccines, COVID money printing starts, we could see Moderna make a move back to the next major consolidation range, which is just this range over here. So if we just draw a simple range box connecting that high to that low, you can see that Moderna could fall a substantial degree. We're trading at around 121 right now, and we could see Moderna fall even up to the high end of the range, another 21.4%. Low end of the range, 55%. Now, shorting a name is always very, very risky. You have to identify your risks, know where to stop out. One thing you should pay attention to on Moderna, or what at least I'm paying attention to, is this key trend line over here. There's a few different ways we can draw it, but if you want to play it on the more aggressive trend line drawing, you connect it through those pivots and connect multi-pivots. You can see we're at a junction point here. This apex of the triangle is very, very critical. If Moderna breaks out, you could test the high over here. If Moderna fails, you could test the low end or the high end of this consolidation range. But I'm liking this one more on the short side and say Pfizer on the long side. Again, that pair trade, full disclosure, I am long Pfizer at these levels. One of the reasons I'm long is you're into this huge 50% retrace. You take the 2009, the GFC low in Pfizer, and you take the high made in 2022, we've now done a 50% retrace. On the weekly chart, you can see we've busted through all of the key moving averages. But one thing I like on this chart, if you look at the monthly chart, you've had very, very aggressive selling, and you have not technically confirmed a breakdown of the 100 monthly moving average yet. Typically, when Pfizer busts through or tests that 100 monthly moving average, you do get an epic buying opportunity. There is a chance that if we have some sort of a freak event or freak collapse like we did in COVID here, you could test the 200 monthly moving average. But again, you have to take your shots somewhere, and this is a pretty oversold condition on the monthly chart. And you're getting a little bit of a rounding formation starting on the monthly RSI. If you look at the weekly RSI, what I like about the weekly RSI is there's a bullish divergence. So what I mean by that is Pfizer made a new couple weekly lows over here, but the RSI has made a bullish divergence. So you've made a higher low. So here's your low, here's your higher low. So it's a little bit of an uptrend. Whereas Pfizer is still technically making a downtrend. So a nice bullish divergence. You're getting a nice crossover potentially forming on the weekly chart. Even if you look at the daily chart, the RSI is still in pretty oversold condition, but has made a bullish crossover on the daily chart besides the price still making bearish divergences. So I am long Pfizer. I do like this name on the long side, and I do think that there's opportunities in the healthcare to short, but primarily if this particular sector breaks out on the daily and weekly chart, which is looking like it's poised to do so, then you want to just definitely favor more positions on the long side. All right, let's move along to the consumer discretionary, which is the bolstering a 10.84% weighting in the S&P 500. Mainly the names that comprise and move this particular ETF are Tesla and Amazon, so some pretty big, important name on the consumer discretionary side. Now, in terms of its year-to-date performance, consumer discretionary has been a powerhouse, up 35.43%. It's bolstering a 7.77 trillion market cap in the overall S&P 500. Now, if we look at what transpired, we were discussing with our members and people who watch our weekly sector analysis a long time ago that this was forming this inverse head and shoulders pattern. You can see it more so on the weekly chart. So the weekly chart shows that we did break out with clear conviction, and it's been in an uptrend ever since. You've had now a bullish crossover of the short-term 7-week moving average with the 100-week moving average. This is just showing you how parabolic this particular ETF is going. It's saying it can't go higher. The actual fulfilled move is all the way up to 183, so it could go even higher from here. But if tech is starting to get a little bit toppy and seeing signs of rotation, it's likely that the consumer discretionary could start to see some more downside. Notice how you are into some very, very powerful resistance trend lines. If I move here, you can clearly see we did get a bullish close above this pivot, but this is decent resistance in a very extended move. I mean, we're super, super stretched from the short-term weekly moving averages, the 7 and the 20. So naturally expect a pullback. Now, something that I'm watching for this particular sector, if we look at Tesla, for instance, Tesla on the daily chart tried breaking out on Friday, made a new little nominal high out of this consolidation range, but closed back inside of that range. So let me just erase this trend line here. What I want to show you, Tesla also making a bearish divergence on the daily RSI. A little bit of a caution if you're starting to buy this, I would like to see a little bit more consolidation in this upper range. The weekly chart does look okay, but there's some gaps to the downside that could mean that it wants to get filled. One trend line that I'm watching, many people are watching the fact that you broke out of this trend line, which is bullish. I'm not watching that one. You do have arguably an inverse head and shoulders pattern that is at play here. You can see this left shoulder, head, right shoulder, and that would actually match up with the underlying XLY inverse head and shoulders. Tesla's is actually a little bit nicer to chart the inverse head and shoulders. So we just have to be mindful that there is potentially a big pattern at play here that could mean that there's more upside. If you do the fully measured move of this pattern, this pattern takes you to about, let's just see on the chart, we're talking about 335 on the chart. Now, one thing I want you to just take as a grain of salt with head and shoulders, inverse head and shoulders, cup and handles, inverse cup and handles, is that patterns don't have to complete the fully measured move to the upside. It's just a guide. And actually bringing into perspective, it's actually less probable for a pattern to fulfill the upside measured move than it is to fill, say, the 50% or the 618. So just be mindful of that just because a pattern has triggered, it doesn't mean it has to reach the fully 100% move. Now, the same is true that it can often mean that it could always overshoot this pattern as well. So you have to really be mindful that there's an overall market trend and breadth that has to be taken into account with these patterns at the same time. One trend line that I'm watching, per se, take a look at this. Pivot to pivot high to pivot high, and you can see that there's maybe a little bit more upside to about 293, 294, pierce of this trend line, and that would coincide with this major consolidation. This looked to be bullish consolidation before you had a bearish breakdown. So pay attention to this area. That's probably going to be the line in the sand to maybe short the XLY or individual names in Tesla. Just be paying attention to that level. It's a big level on Tesla for it to get through. One thing I'm also paying attention to is that you had this weekly little hammer candle from last week, and you have this beautiful weekly hammer this week. The weekly hammer this week has much more volume than the weekly hammer last week. However, you weren't able to close above that weekly hammer. So that's another thing I'm watching for, is a potential bullish weekly close next week above this hammer. If you do, then I do think that you test this 295, 297 level on Tesla. But if you don't, then I think there's a risk that we could go down to fill the gap around that 260, 261 area on Tesla. Let's look at Amazon. Amazon's another one that had a beautiful attempt at a breakout on Friday. Although it did still hold its positive gains on Friday, it had a beautiful topping tail. This is a daily topping tail. We are missing volume, so it's really nothing out of the ordinary right now, but it had a breakout and it closed back inside that previous day high on the Thursday. So maybe a little bit of a failed attempt at a breakout, a little bit of an exhaustion move. It is still super extended on the charts. It just entered that weekly overbought RSI. So notice how stocks do have a tendency to stay overbought for a little bit longer than we think. And doesn't mean that just because we hit the overbought scenario, this stock is going to sell off. I think Amazon, due to the fact that it's in a technical uptrend now, that on pullbacks, it's likely also going to get bought up. Now, this stock could see headwinds if inflation expectations start to really get unmounted again or out of control. If inflation expectations rise, it could definitely be a detriment to the overall consumer. But I would not be buying this sector yet. I would definitely need to wait for more weekly and daily consolidation to go on the long side of this particular sector. All right, let's move along to the staples, XLP. So XLP is interesting. First thing I want to bring to your attention is that we're forming this beautiful bear flag on the weekly chart. So this little bear flag, if we just simply do a measured move from the low to the high, it takes you down to about 69.65, so a pierce of $75. And the significant level of the 69.75 is that if you go all the way back here, this is your breakout candle. This is your wide range green bar, which kind of broke you out of this bearish consolidation base over here. So it makes sense, and it's very likely, since this pattern's max downside retests to a breakout bar, that pattern could actually come into play and fruition. And again, one thing I'm paying attention to is just a simple trend line. Pivot, pivot, pivot. We've broken it, but we have not confirmed, but you are trading below it. I think that if this bear flag triggers, you can get an easy retest of this wide range green bar breakout, and that would likely coincide with the weekly 200 MA. You are trading bearishly on the RSI underneath the key 5288 level for now. Let's look at the daily chart RSI. Daily chart RSI is looking poised to actually go higher. So, it's really going to need the market breadth to pick up if we see the staples want to, make a move to the upside and kind of negate this bearish pattern. But on the weekly chart, it is still technically bearish. Year to date, the consumer staples is down 0.36%, despite the market has been soaring and ripping much, much higher. So you're seeing the names like TAP, Lamb Westing's, Church & Dwight, Costco, Monster, STZ, Clorix, Walmart, Mondelez, are just some of the names in this particular sector, Procter & Gamble, Hershey, that have really just been taking a breather and a cool off. But again, you look at some of the names like PG, which carry such an exorbitant amount of weight in this sector, it really skews this sector, and you have to be mindful of the weightings when analyzing these particular sectors and ETFs, because when one stock has a giant move and it carries about 15% weighting or 14 or 10% weighting in the overall indice, it definitely skews and doesn't give you a clear picture of what the overall market in the staples or consumer discretionary is doing. So one thing I'm looking at on Pepsi here, which bolsters about a 10.46% weighting. Pepsi on the weekly chart is actually above all of the key moving averages, and it's looking like it wants to go higher. If Pepsi can break out of this bearish consolidation range, so notice how you've basically been stuck in a range from this high to this low. If Pepsi can get some follow through next week and really challenge a breakout of this high, you're going to be making new all-time highs very likely in Pepsi, which would bolster very, very well for the overall consumer staples sector. And because this particular stock has a 10% weighting in the XLP, if you look at some of the stocks that have been lagging in this particular thing, let me just go along to say PM. So Philip Morris. Philip Morris has been lagging this particular ETF and sector, but it's still not a horrific chart. On the weekly chart, you're above all of the key moving averages. You're coming up into a wide range red bar breakdown over here. If you can get above that, then it's likely means that you could test the high end of this range, this consolidation range. So again, you're still stuck in a range. This parallel channel has kept you in check. You're trying to make a series of higher highs and higher lows. But right now, this is do or die. If this pattern here doesn't take out this high over here, then it could mean that we're going to take out this low. So just be mindful of that we're still making a series of lower highs. Here's your high, lower high, lower high, lower high. Right now, this is a lower high. Here's your low, here's your higher low. That higher low is negated by this bearish close. So again, this pattern could break down on some of these weaker names in this particular sector. So there's, again, some pair trade opportunities where you look at, let's just go back to like Pepsi. You could be doing a long Pepsi and a short Philip Morris, per se. That's kind of some of the things that I'm looking at personally. Again, nothing is financial advice, so definitely do your own due diligence. But there are some opportunities that should be presenting itself in the near term regarding some pair trade opportunities. I mean, look at Hershey, for instance. Hershey was a powerhouse stock, back in its day, ripping high. It had that failed breakout, and now it's retraced on the weekly chart all the way back to the 50-week moving average. This is actually a decent buying opportunity on the weekly chart. If you look at the daily chart, you can clearly see the daily RSI is overbought. You're starting to get some curling action. But again, this chart has hit support. It had that epic rally, and now it's given up almost all of those gains and retesting a major, major consolidation. So keep your eye on Hershey here, because it is at a decent area of technical support. I mean, you just simply draw a trend line here. You're testing this bar, this breakout bar. So this is a big level for Hershey, and I do think that there's a long trade opportunity here, but you would want to also see the market firm up. And one thing we could see is a capital rotation out of some of the tech communications sectors, some of the rip-roaring sectors, and maybe people moving back into the defensive sectors like staples and healthcare. So that's what I'm looking for, is capital rotation. I think we are at a stage where we're going to see capital rotate into more of the defensive sectors like staples, and as well as the healthcare sector and out of technology and communications. So pay attention to that, because that's certainly something that could mean some more alpha in our pocket. On that note, thank you all for watching this sector review of the consumer staples, consumer discretionary, and communication services. Please give this video a big like down below, subscribe to our channel, and we'll see you on the charts a bit later.